Hello, this is Doug Hensel with Newtown Savings Bank, and thanks for joining us today. This will be one of many financial literacy and banking seminars that we will be offering throughout the upcoming months. With that being said, today's topic is helpful information for first-time homebuyers. I would like to introduce our mortgage loan officer, Stephen Finnegan. Steve is based out of our Shelton and Bridgeport market. His contact information is listed on the first slide. If you have any additional questions, please feel free to give him a call. And now I would like to introduce Steve Finnegan.
Thank you, Doug. My name is Steve Finnegan. I've been a mortgage loan officer. I just celebrated my 36th anniversary as a mortgage loan officer, and I'm happy to be here with Newtown Savings Bank. We're kicking off a first-time homebuyer webinar, and glad you can join us. Let's start. Okay, owning a home. As a homeowner, you can enjoy several benefits. You can build equity. Equity refers to the value of the home minus the debt you owe on it. You can build equity in two ways. First, you build equity as you pay down the principal balance of the loan amount, assuming that the value of your home does not drop. Secondly, homes may appreciate or increase in value over time. So that's the way to build equity. And equity is wealth. You can borrow against it for many purposes, education, home renovations, and other long-term investments, usually at a relatively low interest rate. Be very careful and think twice before borrowing against your hard-earned home equity, because you could lose your home if you do not or cannot pay back the loan. Once your mortgage is paid in full, the home is yours. The word mortgage actually means death pledge. So when you pay the mortgage off, you owe nothing more. There were at one time loans where you owed additional interest after the 30-year period. So once your mortgage is paid in full, the home is yours. Your home ownership may reduce the amount of income tax you owe, since mortgage interest and property taxes are deductible. And I've got an asterisk next to that because I'm asking you to consult your tax advisor. So can you think of any disadvantages of owning a home? Well, there's property maintenance and upkeep. It's not as easy to move as a renter. When you're renting, you can just pick up your belongings and leave. When you own a house, you have to sell the house or rent it out to somebody else. So I'm going to move on. Buying a home. What is a first mortgage loan? It's a loan provided by a financial institution to buy a house or a condo. You repay the mortgage over long periods of time, usually 15 to 30 years. Before we talk about several different types of loans, let us talk about mortgage costs and how to determine if you are financially ready to buy a house. Mortgage costs. First thing is the down payment. Down payment is an initial payment you make when buying a home to help lower your mortgage costs and monthly mortgage payments. You will generally pay a percentage of the cost of the home you want to buy. Typically a down payment anywhere between 3% and 20% of the purchase price. That means, for example, if you want to purchase a townhouse at $100,000, you'll have to pay at least $3,000 up front. And ongoing, you have taxes and insurance to pay, and principal and interest. Mortgage terms and types. Terms are usually 15 or 30 years. Other factors that affect how much the mortgage how much of mortgage you can afford include the length or term of the mortgage and whether the mortgage has a fixed or variable interest rate. Most mortgages are typically 15 and 30-year terms. 15-year mortgages allow you to build equity faster because you're paying down the principal faster and less interest. You make larger monthly payments and you borrow less money. If a 30-year mortgage is more affordable, you can receive similar benefits by paying more than your mortgage payment and applying that extra amount toward the loan principal. You'll also have to choose between a fixed rate and an adjustable rate mortgage. The interest rate on a fixed rate mortgage stays the same for the term of the loan. Therefore, your monthly payments are predictable. A fixed rate mortgage may be a better option if you plan to remain in the home for a long period of time. The interest rate on an adjustable rate mortgage can increase or decrease during the term of the loan. You might have a low rate for an initial period, 1, 3, 5, 7, or 10 years, and then your payments could increase significantly. These loans may be worthwhile if you anticipate moving in the near future or are not concerned about potential increases in the interest rates that may result in your mortgage payment increasing significantly. Or you're reasonably certain that your income will increase significantly in the near future. You may have also heard about interest-only mortgages. With mortgages, you pay the interest, not the principal, for a fixed term, generally 5 to 7 years. Then you can refinance, pay the balance in a lump sum, or start monthly mortgage payments toward the principal. Be very careful with these mortgages because you generally are not paying down the principal, and the interest rate is typically adjustable, meaning the mortgage payments will likely increase over time. In summary, most homeowners will find a 30-year fixed mortgage is the safest and most predictable option for their budget. What makes up a mortgage payment? Okay, principal, interest, taxes, homeowners insurance, and private mortgage insurance. The principal is the amount applied to the outstanding balance of the loan. The interest is the amount of the charge for borrowing the money. Taxes amount equal to 1/12 of the estimated annual real estate taxes on the home, and the same with homeowners insurance, an amount equal to 1/12 of the annual homeowners insurance premium on a monthly basis. In addition to homeowners insurance, this figure may include flood insurance or earthquake insurance. For more information on flood insurance and preparing for disasters, visit www.fema.gov or www.ready.gov. Private mortgage insurance if required. What is an escrow? Taxes and homeowners insurance are often paid from an escrow account, which is a special bank account held by a financial institution for the purpose of paying taxes and insurance. When the financial institution calculates your mortgage payment, they include 1/12 of your estimated annual property tax bill and insurance premium. When you pay your mortgage, the lender deposits this portion of your payment into the escrow account, so the financial institution can pay and the insurance bills on your behalf when they come due. PMI discussed earlier, if required, is also deposited into an escrow account and paid to the mortgage insurance company. You can pay taxes and insurance separately on your own, but you will be responsible for saving money for and paying the tax and insurance bills each year. The bills you may total several $1,000s, so you would only want to pay them separately if you're disciplined enough to save that money. Loan to value and PMI. Private mortgage insurance is required on loans with a loan to value higher than 80%. Essentially what happens is, in this scenario, $235,000 loan at 10% down, the loan amount would be $211,500. 10% of 235 is 23,500. Subtract that from the 235 and you get 211,500. Purchase price of 235 at 20% down, your 80% loan to value would be $188,000. So that's the loan amount at 20% down. And in this case, you would not need private mortgage insurance. Popular loans for first-time home buyers. Here we go. Conventional loans, CHFA, Connecticut Housing Finance Authority. CHFA DAP is the CHFA loan with a down payment assistance, and FHA, Federal Housing Administration. There are many program options for the financing your first-time home loan. Your mortgage loan officer will review with you the options they as a lender offer for a first-time home buyer. In consultation with your mortgage loan officer, you will determine what program best fits your needs. Let's review these popular options for first-time home buyers that lenders offer. Once again, conventional, CHFA, CHFA DAP, and FHA. Conventional first-time home buyer loan programs vary by lender, but generally follow these guidelines. Most lenders offer a conventional loan, especially designed for first-time home buyers. A conventional loan is one not insured or guaranteed by the government. It adheres to guidelines established by Fannie Mae or Freddie Mac. Fixed or adjustable rates are available. These are often general guidelines for such programs found with most lenders. Up to 97% financing for a first-time home buyer. That's 3% down. Mortgage insurance will be required for mortgages with less than 20% down. Income limits may apply depending on a census tract. Your mortgage loan officer will check with the purchase property address to see if it's in one of these census tracts. Suggested debt to income should not exceed 43%. This is generally the lender guidelines per their offered programs. Your mortgage loan officer will help you calculate your debt to income, DTI, when you apply for your mortgage. Minimum credit scores, 620 is the minimum score. Lender guidelines per their offered program can be higher credit scores if required. Most require you to attend a first-time home buyer class. That's conventional loan. CHFA First-Time Home Buyer Loan Program. CHFA is the Connecticut Housing Finance Authority. It's a conventional financing loan program with guidelines and traditional mortgage insurance at a discounted rate. CHFA is committed to helping low to moderate income families and persons achieve the dream of home ownership. One of the greatest obstacles faced by first-time home buyers is coming up with the money to cover the down payment and closing costs needed for the purchase. CHFA does offer DAP, Down Payment Assistance program. But first, let's review what CHFA and what are the guidelines for CHFA. CHFA it has a 3% down payment that's required. Home buyer online education courses required. Online home buyer counseling is available through eHome America in partnership with CHFA. Debt to income ratios, once again, 43%. The mortgage loan officer will help you calculate your DTI, or debt to income. The minimum credit score with CHFA is 680 for the 97% loan to value. It's 640 for a 95% loan to value. So you put down 2% more and you can qualify with 40% less on your credit score. Depending upon the use of CHFA DAP, Down Payment Assistance Program, maximum combined loan to value can be 105% with DAP, Down Payment Assistance. So you do a 97% first, and you would do a down payment assistance program for the remainder of the down payment and closing costs. So you can go as high as 105% loan to value. That's a very forgiving loan to value. Income and sales limits apply per county census tract. Your mortgage loan officer will check the purchase address of the property to see if you are in an eligible census tract. Maximum combined loan to value, 105%, 105% with the down payment assistance program. Discounted interest rates for teachers and municipal workers in targeted census tract. Once again, check with your loan officer if the teachers and municipal workers are in the targeted census tracts. And this can be combined with HDF for down payment assistance. Your release of private mortgage insurance would be at 78% loan to value. That means that once the value of your home is higher, or you pay down enough principal to 78%, you can get rid of your PMI, private mortgage insurance. So what is CHFA DAP? CHFA DAP is a down payment assistance program which allows eligible applicants to finance only the funds needed for down payment assistance, including closing cost. DAP is a second mortgage, meaning you will have a primary first mortgage and a second mortgage on your home purchase. The maximum DAP loan amount is $20,000. The DAP loan can include both down payment and closing costs. Borrowers will be required to contribute $1,000 toward the acquisition costs. So you can do a loan at 105% loan to value. You can borrow everything, but you need to have $1,000 of your own. $1,000 skin in the game is not too much to ask if you're borrowing 105% loan to value. Debt to income ratios cannot exceed 45%, so that's a little bit more forgiving. Your mortgage loan officer will help you calculate your DTI when you apply for your mortgage. Your combined loan to value can be up to 105%, but cannot exceed 105%. The CLTV, or the combined loan to value, takes into your account your first CHFA mortgage, your second DAP mortgage. To calculate the CLTV, add the first mortgage plus the second mortgage, then divide by the home purchase price. Example, if you have a first mortgage loan of $95,000 and a second mortgage loan of $10,000, the total of both loans is $105,000. The purchase price of the home is $100,000. 105 total loans divided by 100,000 purchase price is 105%. So that's a real special program. Lastly, there's FHA, the Federal Housing Authority. A Federal Housing Authority Administration loan is a mortgage that's insured by the Federal Housing Administration, FHA, and issued by an FHA approved lender. It requires lower minimal down payment, 3.5%, lower credit scores than many conventional loans, and debt to income limits of 50%. That's the highest we've seen here with first-time home buyer programs, a debt to income limit of 50%. Your mortgage loan officer will help you calculate your DTI when you apply for a mortgage loan. Borrower does not need to be a first-time home buyer. That's different. So we're doing mostly first-time home buyers here, but in this case with FHA, you do not need to be a first-time home buyer. Mortgage insurance is required. Upfront mortgage insurance is required. Monthly mortgage insurance is required for the life of the loan. Mortgage insurance can be removed at 11 years if the down payment is 10%. All right. Okay, we have second mortgage options. There are many programs that offer help with down payments and closing costs. A few of them are offered here. Housing Development Fund, HDF, they go up to $20,000. And City of Bridgeport has a down payment assistance program. The Federal Home Loan Bank of Boston also has down payment assistance. They're up to $10,000 to $15,000. So there are a bunch of entities that have programs. Some people want to check with their employer, as some companies offer down payment assistance. So are you ready to buy a home? It's important to figure out how much you can afford as the first step. Through this course, debt to income has been mentioned as an important factor in qualifying for a mortgage. Though your mortgage loan officer will help you calculate your debt to income ratio, you can also do this for yourself before you apply. Calculate your debt to income ratio. Your debt to income ratio shows how much your monthly gross income, your income before taxes and other deductions are taken out, goes to covering your monthly debt payments, including your anticipated monthly housing payment. This is the formula for debt to income ratio. Total monthly debt payments divided by your total monthly gross income. Debt to income ratio. The higher your debt to income, the less money you have to pay for everything else. That's because more of your money is going toward covering the debt payments. If your debt to income ratio is 40%, that means 60% of your income is available to cover non-debt expenses. Here's an example of debt to income calculations. Your gross income before taxes, total household monthly income of $3,000 per month. This would be your salary or your hourly wage prior to tax deductions per month. Add up all of your monthly minimum credit card payments, your car payments, and any other loan debt payments that you have. Include your estimated new monthly mortgage payment. That is principal, interest, taxes, insurance, and PMI if you have it. When you add all of your monthly debt bills and your presumed new monthly mortgage payment, you get a total of $1,300. For this example, you would take $1,300 monthly debt payment divided by $3,000 gross monthly income, and it equals 43% debt to income. So 43% is how much you can afford with a $3,000 income and a payment of $1,300 per month. Check your credit history. You can get your credit reports from 3 nationwide credit reporting agencies a few different ways. Annualcreditreport.com is the only place where you can go to get the free credit reports from the 3 nationwide credit reporting agencies that you are entitled to under the law every 12 months. So you get a free credit report once every 12 months. You also have other popular options like Credit Karma. Once you have an idea of your credit score, it will help you determine what rate you may qualify for at the time of the mortgage loan financing. Lenders use credit scores to determine not only if they wish to extend credit to you, but also the rate that you would qualify on your mortgage. If you find something on your credit report that is inaccurate, you can contact each credit reporting agency. Equifax is 866-349-5191, TransUnion 1-800-916-8800, Experian 888-397-3742. Figure out the financing. Shop lenders to find the best interest rate. Many lenders offer free pre-qualification or pre-approval to help you with your home search. A pre-qualification is an informal evaluation of finances. Generally, no documents are required. Verbal conversation regarding income, assets, and credit and pre-qualification letter is issued, versus a pre-approval, where is a formal application taken, complete financials collected, credit is pulled, application is fully underwritten, and a commitment letter is issued. A pre-approval is, in this market especially, is a generally preferred vehicle for making a bid on a house. So ask your loan officer for a pre-approval. Shopping and buying your house. Consider contacting a local realtor to help you in shopping and contract process for your new home. Realtors do not charge you to purchase a home, and you will help. They'll help you negotiate with the seller. They can also guide you in the home inspection process. And then a closing. When you buy your home, you have a closing. Closing occurs when the borrower meets the seller and the other representatives to sign the documents that will finalize the sale of your house. And any mortgage financing, this is the completion of the home sale for you and the new owner. Okay, predatory lending. So there are some non-scrupulous lenders out there to be sure you're making yourself aware of. Abusive practices include excessive fees, abusive prepayment penalties, loan flipping, unnecessary products, asset-based lending, steering, and targeting. You want to stay away from lenders that request those type of programs. You want to avoid predatory lenders, pay your bills on time to ensure that you have good credit, and review your credit report every year. Be an informed consumer. Shop around for the best deal. If a lender is unwilling to give you the information you need to comparison shop, then you shouldn't do business with him or her. Ask friends, family, and credit counselors for advice. Take someone along with you when you talk to a lender. Do not let lenders pressure you into making a decision before you are ready. And be careful of lenders who tell you they don't care about your credit history or how much you earn. Many of these lenders charge higher interest rates and higher fees. Disregard advertisements that make lending sound cheap and easy. Read and understand all the documents before you sign them, and keep copies of what your lender gives you. Work with lenders who have a good reputation and customer service that's easily accessible. Will your lender be there for you? Where will you make your mortgage payment? Many lenders don't service their loans they close. They basically sell them. Will you have options on how to make your payment? Make sure you'll be treated like a value customer and not a number. Will they be there for you after you close for the questions that you may arise? Look for a lender who is committed to servicing your community. And that's Newtown Savings Bank. Home ownership is possible.